Hi, all. My name is Chris McNamara, and today we'll be training on sensitivity analysis and its role in capital budgeting. So let's dive right in. So, what is a sensitivity analysis? They show us what if scenarios that the firm can use to make informed decisions. The results are shown to managers to help them make decisions about where to reduce risk and how to grow the firm. It is the main tool used in capital budgeting to forecast for different periods of a firm's life cycle. The key tasks that a sensitivity analysis accomplishes is forecasting and analyzing risk. Without a clear picture ahead of the risks being taken, firms may lose control of their budgets and eventually fail. While there are many financial considerations for sensitivity analyses, these qualitative and quantitative factors sum up the main points of focus in most analyses. Some important qualitative considerations are what if scenarios. What if scenarios play an important impact on the relevance of your analysis? While nothing is impossible, there are many scenarios in which we can omit from our analyses. Risk levels. Risk levels need to be considered because they create a shared understanding of where things can go wrong and how bad. General assumptions. These are common or generally accepted happenings in a business that will normally go unchanged unless acted upon. An example of this might be the loss of 100% of your inventory being nearly impossible because you have two separate storage companies. The general assumption there is that you will never have zero inventory unless you sell it all yourself. Lastly, we have the SWOT analysis. Personally, this is my favorite way of examining possible risks of a case or a project. And when you take all of them into account and consideration, it's hard to miss the risks. On the qualitative side, we have several important factors that give us information. The pro forma statements are what ultimately show us a forecast into the future. This occurs mostly in the form of the income statement and the cash flow statement. The balance sheet is rarely used for this. Discounting, payback period, internal rate of return, changes in volume, changes in cost of goods sold, and changes in input variables all need to be considered when using the pro forma statements. They are what drive the decisions and allow us to forecast properly. Sensitivity analyses follow a series of steps that allow us to get to the target value and identify risks. Step 1 is determining the scenario. Scenarios are based off the project or the case that you want to identify. Step 2 is building your base. Building your base should show you what effect the case will have on the financial statements and the firm. Step 3 is determining the possible effects of the case. The question you want to ask is, what will my project or case affect in the firm, and how will it affect that number? This is how you acquire your target variables and your input variables. Step 4 is varying the input assumptions. By varying the input assumptions, each analysis will show us the left and right limits for the possible effects of a business case or project. And lastly, step 5, we need to consider and test any limitations to the proposal. The firm may give limitations to either the input variables or the target variables. For example, the firm may say we need the internal rate of return to be 22% for us to invest in this project. Once you input that target variable, you just work backwards from there. Capital budgeting plays a vital role in firms' ability to grow while operating. The capital budgets detail the planned capital projects during a designated period, plan out the budget for the next period, give managers the tools to make decisions about the firm, brings awareness to downfalls or opportunities that the firm can adjust to, and lastly, uses the sensitivity analysis to plan for variations in the market or products. Now, the question we ask ourselves here is, where do sensitivity analyses and capital budgets actually meet? Ultimately, the identification of risk is where the two become useful together. While the capital budget and the sensitivity analysis may be different, they can be used in tangent with each other to determine risk. When a plausible input variable is inputted into the pro forma statement, and the target variable is not up to standard, the risk of that outcome is then communicated to managers. When managers understand the risks of investment, they can adjust the risk level by either not investing or making changes to the inputs. Sensitivity analyses give managers the tools necessary to make informed decisions and forecast for the firm's future. This concludes today's training on sensitivity analysis and the capital budget. Thank you for joining.